Hello traders, and welcome to a new day trading strategy video of mine. In today's video, we're going to be looking at the Ichimoku cloud as suggested by my Patreon. So what we're going to do today is look at how is this indicator calculated, what is this indicator and why would we want to use it, what possible strategies are we going to want to use by looking at it, and what factors of Confluence can we use to complement it. This is going to be more of a basic intro beginner's video to the Ichimoku cloud, where I'm going to be leaving out some of the more complex elements. In the future, I am going to be doing an advanced and possibly an expert video on how to use more advanced strategies with this indicator. So Ichimoku cloud, it's also known as a more powerful exponential moving average. I don't really agree with this because it looks like Bollinger Bands, it looks like exponential moving averages, but its calculations are a little bit different. And not only does it have one calculation, it actually has 5 different calculations in one indicator. And that's why we're going to get 5 lines within this indicator. 1, 2, 3, 4, 5. And what these 5 lines show us are trend direction, likely reversal points, and support and resistance. So with this indicator, it's very different than any other traditional technical analysis indicator because it contains both lagging and leading values. So what I mean by that is, as you can see, this indicator uses leading values. So it's plotting this current price information to show you future support and resistance areas. But it also has lagging values, as you can see. Let me put that up, the lagging span. This is the exact opposite. So not only does it go in the future, but it plots this present data in the past. So let's go take a look at the calculations behind what makes the Ichimoku cloud do what it does, because I believe that if you don't understand how an indicator is calculated or how an indicator is derived, then you're going to be having some issues down the line when you're actually trying to use the indicator. So let's begin with the calculation, then go into the more fun part, the strategy. The first line that we have is the conversion line, and that's the line in blue that we have here. To get the conversion line, what it does is it takes the last 9 bars and it plots the midpoint. So I'm going to go back 9 bars, and we get the low of those 9 bars, which is there, and we get the high of the 9 bars, which is there. That midpoint is going to be our blue line, or the conversion line. Now, the second line we have is known as the baseline. The baseline is the last 26 bars with the midpoint. So if we go back 26 bars this time, that's going to be back to here. The very low was there, the very high was here, and that is the midpoint. Now, the third indicator is what we're not going to be talking about as much today, which is known as the lagging span, and that's in black. All that is just the close price plotted 26 bars in the past. So it's actually just a mirror for price. It's the exact same, just 26 bar offset in the past. That can be used in a few different ways. But I don't really want to talk about how we use those past values in today's video. So we're going to be disabling that for the remainder of this video. And then we have the last 2 indicators, the last 2 lines of this indicator, and this is what's going to make up that cloud that many traders are probably familiar with. Lead 1 and lead 2. Lead 1, let me show exactly what lead 1 is. Lead 1 is just the top part of the green cloud and the bottom part of the red cloud. So it's that green line that you see there, that green line going up there. And this red line here is known as lead 2, as you can see. Whenever lead 1 crosses above lead 2, what that's going to do is paint it green. Whenever lead 1 crosses below lead 2, that's going to paint it red. Now, in order to get lead 1, it's just conversion plus the baseline divided by 2. So it's the midpoint between the conversion line and the baseline. So what that is we would get this, we would look at this right here, we see where the conversion line is, we see where the midpoint is, where the baseline is, and we plot the midpoint of that, which would be, if I'm looking at that right there, that would be there. And that's exactly where it is, as you can see. Now what we also have is the final part, which is lead 2. This is the 52 bar high plus the 52 bar low divided by 2. Basically just the midpoint of the last 52 bars in a similar way to how the baseline and conversion line are calculated, except this is 26 bars in the future. So what that's going to look like is this. We go here, let's take a look 52 bars in the past. That would be here. That's the past 52 bars. The very low would be here of that last 52 bar period. The very high would be here of the last 52 bar period. And the midpoint, as indicated by my clicking there, is right there. And that's going to get us lead 2. So that's the calculation of the 5 components of the Ichimoku cloud. Now let's go into the more fun part. The basic strategy is when lead 1 rises above lead 2, the cloud turns green, we want to look to buy. That's going to be indicating that we're beginning to see some more bullish pressure. When the opposite occurs, when lead 1 drops below lead 2, the cloud's going to turn red, we're looking to sell. So this is what it's going to look like when you get that crossover with a bullish crossover. This is what it's going to look like when you get the bearish crossover, when lead 1 goes below lead 2. Now, we don't want to just buy when lead 1 goes above lead 2. We're not going to buy here, and we're not going to just sell right there. That's where the other components of the Ichimoku cloud come into play, with telling us exactly when to buy and exactly when to sell. So when we look at that, this is how we decide when to enter. When the cloud is green, we're looking for a crossover of the conversion and the baseline. So if you see what this 1 is indicating right here, we have a green Ichimoku cloud, so we're looking to buy. Red Ichimoku cloud, we're typically looking to sell. Now, we see the blue line move above the brown line right there. It was above before, it went flat, and then we get a crossover. This is indicating that we should likely buy. Green Ichimoku cloud, crossover where the conversion line, blue, is crossing above the baseline, brown, you want to buy there. Now, when the cloud is red, you're looking for a cross under of the conversion and the baseline. So that would be, back in this chart here, you would get that whenever you see this turn red and whenever the blue line crosses below the brown line. That's when you're likely going to want to sell or to short. Now, that is the first strategy for entry. There is another way that you can enter, and this is going to be a little bit more aggressive. This is when we're looking for price to cross above the baseline when the cloud is already green. So what that's going to look like, I think it's like frozen there. Yeah, here we go. So what that's going to look like is 2 here. Whenever you see price close above the brown line or the conversion line, or the baseline, when price closes above the baseline, that's when we're looking to buy. So right there, when that doji prints, we close above the base and we're looking to buy. Whenever price crosses below the baseline, when the cloud is red, we're typically looking to sell or to short. So here we're red. We see that the first time that occurs is here. Price goes a little bit above the baseline and then goes right below the baseline and doesn't go above it for quite some time until here. So this would have been a good spot to short. Maybe this would have been a good spot to exit that short. Now, we don't want to just talk about entry without talking about the exit. With exits, we're going to want to take profit or take loss on a long position in 2 ways. The first way that we can do it is very aggressive, which is just price crossing below the baseline when the cloud, irregardless of what the cloud is doing. This is something that you can do if you want to take a quick profit or a quick loss. So what I mean by that is we have a green cloud here, we have an uptrend. Now we also have price, really at this point, price is not going below that baseline. It's not till here. Price just close below the baseline. That's a possible spot where you could exit and sell. You sell right there, and you don't have that kind of drawdown. You don't have that loss. That's aggressive. A little bit more conservative is to wait for price to cross below all 4 lines, but this may be a little bit too conservative. But if you really want to play it very safe, what you could do here is wait for price to close, not just price to close below here, but wait for price to close below all 4. So at that point, it'd be here. It's crossing below every single line at that point. That will work in some situations. So when we look at this chart here, you can see that price is relatively flat. It's not closing really above all 4 lines except for here, and then that begins to stop. And then look when it closes below all 4 lines, which is here. We have price going here, price quickly goes down, crosses below all the Ichimoku lines, and then price just continues to move down. So this would have been a spot to exit your long, at a loss likely, but potentially at a profit after close below all 4 lines. Now, those are the 2 ways that we can exit. Again, you could just wait for a red cloud. That's, I'd say, like the third way to exit is just to do entry for a short to exit your long. So you would wait till the cloud goes red, and you'd look for a cross under of the conversion and the baseline. And that's a way you could wait for just the Ichimoku cloud to turn red. But if you want to be more aggressive, these 2 methods are going to be more the way that you may want to trade. You may want to exit your long even when the Ichimoku cloud is green, but if you want to be very conservative and just trade it by the book, then you can wait for the Ichimoku cloud to turn red, and then you want to sell. All right, so take profit, take loss on a short position, just vice versa of the long position. When price crosses above the baseline, we can aggressively take profit on our short. So imagine we shorted here, and we're holding. Price is still below that baseline, still below the baseline. And then here, we cross above the baseline. We're still in a red cloud though, but this is indicating that we may have a spot where we can cover our short and we don't have this kind of drawdown. We don't lose this money because we short there and we exit here. Now the second way is price crosses above all 4 lines, which occurred here. Price is flat, ranging, hits some stop losses likely here and then springs forward on demand. And we cross above all 4 lines right here on very high momentum and on very high volume. This is likely not a great spot to hold a short. This is probably a spot you want to just take the loss if you had shorted in this range, or take a slight profit if you were lucky enough to short near the top point of this range here. You just want to get out of the market here because we're getting a cross of all 4 Ichimoku lines, and price is likely just to continue its bull run, which it did. Again, the third way that you could exit your short is by using the entry method for a long, which I explained before. So if the cloud suddenly turns green, so we're trading here, we have a short, and the cloud turns green right here. This is a spot where we probably do not want to be in a short. Here as well, this way it may not have worked as well, but you can see that the cloud did turn green, but we didn't get any indication for us to exit our short anyway because price was still below the baseline and the conversion line was still below the baseline as well. So this wouldn't have really hurt us in any way because we're not getting any indication to sell here, as you can see. That's why we always want to look at other factors of confluence even within the Ichimoku cloud. We don't want to just sell when the cloud is red, and we don't want to just buy when the cloud is green. We need to look at other ways of exiting from the very aggressive, such as this, to the more conservative of waiting for the cloud to shift and then looking for a spot to exit your trade. So not only do we use this for trend direction and for crossovers, but we also can use this for support and resistance points. And the way you do that is by using the cloud edges that act as support or resistance. So when the cloud is green and price is above, trending above, as you can see here, that green cloud, we're looking for price to bounce off the outer edge of that cloud. So a look at that would be here. Price is trending above, and then we have a bounce there. We go up, we bounce again, we bounce one more time, and then we continue to go higher. So similar in a way that you would use parts of the Bollinger Bands where you're using bounces of the bands, you could use the bounces of the Ichimoku cloud for support and resistance. And the reason that this may work is remember that this is, I know the calculations can be a little bit tricky, but it's the average of the conversion, the baseline, 26 bars in the future, which could show you spots where price has spent a large amount of time at, or price has had more of a midpoint at when it's been ranging, which could show you great spots for support or resistance, as you can see there. Now, when the cloud is red, we're looking for price to bounce off the top edge of the cloud. So price is trending down, okay? We're still looking to short. We get a period of low volatility, and we touch this part of the cloud. We touch the bottom part of our cloud, and then we go lower. We touch it again here, and then we go lower before we finally pierce it, and potentially pierce all 4 lines of the Ichimoku cloud as well. Now, we don't just need to use the outer edges, but we can also use the inner edges for final support or final resistance. So final support can be found in an uptrend when price bounces off the inner edge So what that would look like is, imagine here we're in an uptrend, but price at this point actually goes all the way down to here and then goes higher. What it's doing there is it is using the 52 bar midpoint as support before bouncing higher. And what it'd be doing for a downtrend, so final resistance that can be found off of, final resistance that can be found off of the inner edge where price bounces off. Let me show that here. Price goes up, uses this inner edge here. So remember, this is the 52 bar midpoint, respects it, goes lower. Goes up here, pierces the initial resistance, and uses this as final resistance before going lower. It's not able to cross above both lines of the cloud either time. It is contained within the downtrend, and it stays red until we get to this point here where we get a little bit more of ranging. So that's the way that you would want to use support resistance when you're looking at both the inner and the outer edge for that. For a question of when do I use the inner, when do I use the outer, typically a rapid bounce is going to be a good sign. So a rapid bounce, this isn't really that rapid, but you get here, and then we get a bit of a morning star candle here. Morning star is when you have bearish candle, doji, indecision candle, and then you have a bullish candle with that kind of three-way setup. We go higher. That's one way that you may want to just respect this instead of waiting for price to go down to here. And then when you look at these examples here, we see price moves up to resistance, doesn't really respect it, just consolidates and continues to move higher. When you see price consolidating at resistance and then slightly moving higher, that could be a bullish sign, and price goes to the upper edge. Same as here. We get just flat price. Doesn't really look like the sellers are that interested in selling down, so price just goes up and touches the inner edge of the Ichimoku cloud there. So now I want to end this video for a basic guide to the Ichimoku cloud with factors of confluence. We never want to use an indicator, even an indicator as complex and intricated as the Ichimoku cloud. We need to look at other things as well, and that's where Fibonacci's can come into play. So Fibonacci's plus the Ichimoku cloud, one way that you may be able to do that is to look for overlapping areas of support and overlapping areas of resistance. So if you were to plot a Fibonacci from high to low, this would likely be around the 38.2% retracement. So one way you could use that is we see that the top band, the top line of our Ichimoku cloud here is there. Imagine the 38.2 resistance was here as well, of here to here. This could be a spot of confluence where we may want to look to sell. You could also use Fibonacci extensions as well if you know how to use those. And that could be drawn in a way where we're looking at, drawing from here to here and extending it down to this point here. But that may be branching a little bit away from the Ichimoku cloud. You want to use it mostly as just overlap. We can also use RSI plus the Ichimoku cloud, and that's going to be showing us RSI divergence to gauge whether a support or resistance level is strong or weak. What we see here is price moving up, price makes a higher low, RSI makes a lower low. This is known as divergence, where we're expecting that RSI is showing us that the momentum is waning and the price is likely to move down, as it eventually did. A way you can use RSI divergence when you're looking at the Ichimoku cloud is this is green and it's telling us we want to likely buy. But we look at RSI is not telling us that we want to buy. This is not a good sign. So because we have indecision between two indicators, we'd probably want to do nothing. We probably just don't want to buy and we don't want to sell until we get a stronger point of indication. That stronger point of indication could have turned when we have a red cloud, and then we could look at RSI, or when RSI begins to really diverge, as you can see here to here, it's confirming the lower low. And then this could be a spot where we may want to look to potentially sell, even though the Ichimoku cloud is still green, where we typically don't want to sell. So that's one way you could use RSI divergence. And there are a ton of articles and a ton of videos on how to look at RSI divergence, and likely many ways to articles about RSI divergence in conjunction with the Ichimoku cloud. And the final way that I would recommend using the Ichimoku cloud is with volume spikes. So we're just going to use volume spikes in conjunction with a green or red cloud to show us points of likely reversal. So if I was to go to my chart here, and we're looking at the Ichimoku cloud, when we look at a major volume spike on the 1 hour chart, we can see a major volume spike occurred here, price reversed. Major volume spike occurred here. A lot of people sold, price reversed. Volume spike, price reversed. Volume spike here, and price went higher, and then some shenanigans here where price went down, hit stop losses, went up, and then consolidated, volume spikes there. And then we get a few volume spikes here. One way you can use the Ichimoku cloud with these volume spikes is, again, just to gauge, should I buy or should I not buy, or should I sell or should I not sell here? And one place to do that is when we look at this Ichimoku cloud, it's really not showing us anything that committal. I'm just seeing the conversion line going a lot lower than the baseline, which is typically pretty bearish. But probably not looking to sell here because I'm seeing a major volume spike followed by a period of flat, low volatility. Not a good sign for the bears, and price did go higher, which was good for the bulls. Another example here is we have a green Ichimoku cloud, which is already bullish. We have a volume spike here in a downtrend, which again is typically bullish. So this could be a spot where we may actually want to buy. We would have bought here and potentially targeted the upper part of the band. So you could have even sold this by using this as resistance. You sell this when it goes to the top part of the band there, and you prevent yourself from any drawdown. But again, that's just 20/20 hindsight. But it is another way that you can use the cloud. So this is a spot where both the Ichimoku cloud and volume are on the same page. They're both indicating something quite bullish. So it would be a spot you may want to buy. Here, again, we see respect of the outer edge of the cloud. It's green, volume spike on a downtrend, and price goes up. And if you're ever curious about more about volume or price action, how I'm reading this, you can check out my other videos on volume as well. And those will be able to better explain what price is doing and why volume is doing what it's doing as well. We can also see some pretty nice resistance here with the outer edge of the Ichimoku cloud before price moved lower down to there. With volume spikes that I had talked about before, volume spike, price goes up, volume spike, price goes down, and so on. And using that to either choose to, should I buy, should I not buy, is volume in convergence with the Ichimoku cloud, or are they telling two different stories where I just don't want to take a trade at all? And again, that's all due to the indicators that you use and the indicators that you give more weight to. So if you give more weight to volume and Fibonacci's, then you do the Ichimoku cloud. If the volume and Fibonacci's say to buy and Ichimoku says to sell, you may want to buy. But again, that just comes down to your risk tolerance and the amount of weight that you give. So that's going to be it for just this basic intro to using the Ichimoku cloud. If you have any questions on a more advanced way to use it, or any questions in other parts of the theory or other parts of the calculation, you can leave a comment below, or you can check us out on our Discord, or you could join the Patreon if you want to vote on a future video. With that, happy trading.